Now let us have understanding of the learning points that we have, say, in our chapter of dividend decisions. Dear students, we understand that basically as a company, the company is raising the funds from the different sources of the finance, and so that amount is invested in the business. Whatever the earning that you have from the business is called technically the operating income, earning before interest and taxes. That's what we understand is the operating income. From the operating income, first of all, you make the payment of interest. We know that the payment of the interest is unconditional. Whether you have made a profit or you have incurred a loss, in either of the case you have to pay the interest. Then you have the earning before taxes. That is, interest is deducted from the operating income and you have EBT. From that the tax is deducted and you have earning after taxes. If at all you have issued the preferential capital, then in that case the payment of the preference dividend is mandatory before you make payment to the equity shareholders, otherwise it is not mandatory. If at all you are making the payment of the preference dividend, then in that case you don't have to think about that what is the rate at which it is supposed to be paid. It is required to be paid at a fixed rate. After deducting the preference dividend from the earning after taxes, we are left with earning available to equity shareholders. From earning available to equity shareholders, equity dividend, if at all we pay, it is deducted. We know that the payment of the equity dividend is absolutely voluntary. If at all the company does not pay the equity dividend, say, throughout its life, then in that case nobody can compel the company that say you have to make the payment of equity dividend. Legally the company is not at all bound to make any payment of the equity dividend. The company may have a huge profit, the company may have the listing, or the company may be having in existence for last 20 years or 50 years or for any other number of years. Payment of the equity dividend is voluntary. However, we understand that yet it is voluntary, but there is always an implied pressure on the company to give return to the shareholders. Return to the shareholders is we can measure the same into two aspects. One is the change in the price which the investor is getting, and the second is the dividend income, that is the cash income which the investor is receiving. In this chapter, dividend decision, in this chapter, the learning part of the chapter is to decide about payment of equity dividend in a way that if at all the company has positive earning available to equity shareholders, if at all the company has positive earning available to equity shareholders, then in that case, importantly, the company is required to decide whether any portion of this earning should be paid in form of dividend or not. Should the company pay entire earning in form of dividend, or should it pay nothing, or should it pay a certain portion of the earning? So what amount of the equity dividend to be paid is what we are going to have the learning point in this chapter. For example, say we learn something like this. When we study the capital budgeting chapter, what do we have in our mind? We have in our mind that say we are going to take a decision whether the project is beneficial or not. We make the computation of the NPV to decide that say whether the project is worth accepting or not. Similarly over here, in this chapter, we have a focus point that whether the company should pay equity dividend to the shareholders or not. That is what's the decision that we are going to understand over here. So first thing that we have discussed is that the decision making that we are going to understand over here is whether to pay equity dividend or not, and if at all we are going to pay, then in that case how much equity dividend should be paid is what we are going to understand as a part of the decision making over here. That is the first thing. Listen me carefully. Second important thing, this decision is required to be taken in such a way so that ultimately you are able to maximize wealth of equity shareholders. How should you take the decision? The decision should be taken in such a way so that ultimately you are able to maximize, you are able to increase wealth of the shareholders. Okay, how do we measure wealth of the shareholders? How do we measure wealth of equity shareholders? Wealth of equity shareholder is measured by way of current market price of equity share. Whatever is the current market price of the equity share is technically considered to be wealth of the equity shareholders. So over here we understand that as a company you should take the decision about the equity dividend payment so that it is increasing wealth of the shareholders, which is measured in form of market price of equity share. So you should take decision about the payment of the equity dividend in such a way so that say we are going to increase the market price of equity share. This is what we understand. So we understand that, so the concluding the point, in this chapter we are going to understand the payment of the equity dividend. Equity dividend payment should be in such a way so that say ultimately it maximizes the wealth of the shareholders, which is measured in form of current market price of equity share. That is what we understand. Okay, right on heading learning points of the chapter. In the write down, first point, in this chapter we are going to learn about payment of equity dividend. Second point, we are going to take decision about payment of equity dividend in such a way so that it maximizes wealth of equity shareholders. Full stop. Wealth of equity shareholder is measured by way of current market price of equity share. Full stop. Hence, decision about equity dividend payment should be such so that it increases market price of equity share. This is what we understand. Proceeding further for explanation. Now friends, suppose on the YouTube I make a search like this, that how can I clear my CA intermediate in first attempt. Suppose I do a search like this, then you know that say there would be number of videos that say that will be displayed. Suppose I watch 10 videos that say how can I clear my CA intermediate examination in first attempt. I watch 10 videos. Every video is giving some instruction about studies. What do you think? All of them will give me same instruction or they will give different instruction? We understand that say most of the videos will be having say the different instruction or different method of the studies. See, none of the speaker wants to confuse me. Everybody wants to guide me only. Yet we understand that say the method of studies for everyone is different. If at all you ask me that say how you should study, then I'll tell you something like this. If you ask somebody else, then in that case, say the method of the teaching, method of the studies that say the other faculty would recommend to you would be different. A student who has recently passed, ranker student, moderate, average student, all of them will have their own method of studies. So nobody has that is an intention to misguide you, yet the method is different. Exactly something like this happens over here also. In order to decide that what amount of the earning should be paid in form of equity dividend, we are going to understand certain dividend policy theories. We are going to understand something like called Gordon model. We are going to understand Walter model. Then we are going to understand Modi-Gilani Miller approach. Modi-Gilani Miller approach, Lintner model, Graham and Dodd model. Like that, so we are going to have understanding like the expert's opinion, say with respect to the payment of equity dividend. As I told you that say view of experts may not match. Similarly over here, say whatever the dividend policy theory that say the Gordon model have given may not match with the MM approach. It may not match with the Graham and Dodd model. We don't have to make any internal comparison. We just have to understand the assumptions which respective theory has made, and based on that say we are required to write the conclusion, we are required to apply the formula, and with that say we are required to make the relative calculations. MM approach or Gordon model or Walter model will provide their conclusion with respect to the payment of equity dividend that we have to understand. They will provide mostly say the formula for say making certain numerical calculations that we have to understand. From examination point of view, we will surely be provided with the information that say which dividend policy theory is required to be followed, and based on that say we are required to give the conclusion. So this is the way we are going to have say understanding of the dividend policy theories in this dividend decision chapter. So now third point, okay, after the second point, write down third point. In this chapter, we are going to learn first Walton model, second Gordon model, third approach, in bracket write down Modi Giuliani Millard approach, fourth Graham and Dodd model, and fifth Linton model. With paragraph write down conclusion of each theory may match, comma, may not match with other theories. Full stop. We only have to understand each theory separately along with its assumptions and calculations. Full stop. Heading right down Gordon model. Heading right down Gordon model. Now, as far as the Gordon model is concerned, what kind of conclusion it has for the dividend payment, I explained that to you along with the assumptions and the calculations. But before that, I would like to discuss, say, a small example with you. Like all of you must have heard about the uh, name of the company called Reliance, and we know that the Reliance company is basically owned by Mr. Mukesh Ambani and his family members. Let us say that I am holding, suppose I am holding 10 equity shares of Reliance company, and one fine day I think that I am also owner of Reliance company because I am holding equity shares of the company. So I go to the Reliance company's head office and I'm entering into the building. That's the watchman is just inquiring with me that says, sir, where do you want to go? And I reply him that I'm owner of the company, I'm holding equity shares of the company, so I want to check the accounts. And with that intention, I want to go inside. What he will do? We understand that he will tell me to go out of the premises. He'll tell me that sir, not you, but there are lakhs of shareholders who are owner of the Reliance company. However, you cannot go like this. So basically, we understand that I am a minority shareholder. Basically, we understand that I am a minority shareholder, and Mr. Mukesh Ambani is real owner of the company. That is what we understand. Further, let us say that there is a news in the market that Reliance company is going to face, say, a heavy penalty, say, due to violation of some laws. Then in that case, what I will do, soon after I receive this, say, news, I'll make sure that I sell my shares as soon as possible before, because of that news, price of the equity share is falling down. That is the way I would like to sell my investment. Whether Mr. Mukesh Ambani will do like that? No. He will make best effort so that the penalty is not levied on the Reliance company, and if at all that penalty is levied, then in that case he will try to find out the ways so that this penalty, like the expenses, can be recovered by, say, some business model or by some business revenue. This is what's the difference that we have, say, of the real owner and of a minority shareholder. In case of the real owner, we understand like this. Real owner will think like in this way, that whatever is the earning of the company, whatever is the earning of the company, that earning is basically belonging to me. So if at all I reinvest the same in the business, then what is the rate at which I am able to earn? And if at all that earning is paid in form of dividend, and if at all I invest that amount somewhere else, then what is the rate at which I will earn? That is the way, say, he will be making a comparison. He will not like think about a minority shareholder who always thinks about some dividend income, who always thinks, say, about the short term time period in which he wants to make a gain. The real owner will consider that, say, I am owner of the company. So if at all the company is retaining the funds, then in that case the real owner does not have a point that, so this company is not making payment of dividend, so this company does not have the bona fide intention. A minority shareholder may have a kind of concern like this, that if at all the company does not pay dividend, then in that case the shareholder may have a point that in spite of the fact that, so, there is adequate earning, this company is not making payment of dividend and this is not worth investing. So the point of views are absolutely different. As far as the Gordon model is concerned, this model is giving the conclusion, so, from the real owner point of view. Why do I create this kind of background before we study this? I create this kind of background because basically we are going to understand certain conclusions which you may find surprising, which you may think that, say, so this is not, say, something which I can digest. So when you recall this explanation and along with that, say, that conclusion, then in that case you will be able to digest it. Then you will be able to understand, say, why the theory is, say, giving certain conclusions like this. That is the reason, say, I am giving you explanation about real owner and about, say, a minority shareholder. This is what we understand. Okay. Now, before we start with the conclusions, that is the assumption, calculation, that is conclusion, I would like to do one question with you. So let us start with this one question and then we are going to understand it, because this question is basically forming part of the Gordon model only. So let us see this question. X Limited has issued equity share at the rate of 1000 rupees. Rate of earning of the company is 25%, where the company has dividend payout ratio of 40%. Retention ratio is 60%. You are required to find dividend per share for the first year, for the third year, and growth rate in earning and dividend. Please try to calculate the answer on your own. So write an answer. Calculation of dividend per share from end of year 1 to end of year 3. Will compute for the 3 years. Column number 1 is year, first year beginning, investment. It is 1000. Earning per share is, rate of earning is 25%. So 1000 into 25%, that comes to 250. Dividend per share, dividend payout ratio is 40%. So 250 into 0.40, that is 100 rupees. The remaining is the retained earning. So it is 250 minus 100, that comes to 150. So second year beginning, the amount of the investment will be double 150. It is 1000 plus 150. Again you earn at the rate of 25%. So it is double 150 into 25%. So double 150 into 25%. So it is 287.5 into 40%. That is 115. Remaining is the retained earning. So it is 287.5 minus 115. So the answer is 172.5. Third year, double 150 plus 172.5. So investment is 1322.5, friends. 1322.5 into 25%. So it is 330.625. 330.625 into 0.4. So it is 132.25, friends. And the remaining is the retained earning. 198.375. Okay. So the dividend for the first year is 100 and dividend for the third year is 132.25. So the third question is, calculate the growth rate in earning and dividend. So again, the growth rate is very simple to find. Growth rate is B into R. B stands for retention ratio. We pay dividend equal to 40% and we retain 60%. So 0.60 into rate of earning of the company is 25%. So 0.60 into 0.25. So 0.10, that is 10%. That is the way the growth rate of 10% can be calculated. Sorry, growth rate will be 15%. And that is what we can see. From 100 it increases to 115. Plus 15% it increases to 132.25. That is the way the dividend per share is increasing at the rate of 15%. Same is the case with the earning. From 250 plus 15% plus 15%.